Welcome everyone. This is our November AI Circle, and we have a lot of fun stuff coming your way today. So let's just jump right into what we're going to cover today, which is a market recap with Kelly. And some of the smartfolios have had significant updates. We bought back into the S&P 500, the SPY specifically. And those of you who are invested in the 4Q rotate smartfolio may have noticed a big shift. A lot of stocks were swapped out. We're also going to, towards the very end, I'm also reserving a little bit of time to give you an update on the product side of things about crypto, right? So we'll save a little bit of time at the end for that and any questions that you might have as well. But first, we have to get through the boring stuff. We have to always start with our disclaimer. So bear with me as we go over this. iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip smartfolios that you select are suitable for your investment profile before trading in a live brokerage account. With that out of the way, I'm going to hand the mic over to none other than Mr. Kelly Korshak. First things first, let's start with a market update. It's been a couple of months actually since we last met up here. So could you recap both September and October for us?
Absolutely. I think there is much to go over. The last time we spoke was the end of September, the end of August, and I was turning bearish personally. And my reasoning at that time was that the September, October are generally very rough months. There is volatility in those months. I was looking for an opportunity towards the end of October, beginning of November to get back into the market. And wow, did we get a chance to do that. So I was wrong in the market, but not that wrong. But now we are going forward towards the end of the year. And as any good trader can see, and even if you're a bad trader, this market is just too strong to stop. So let's take a look at the market here. This is the S&P 500, and it has the advantage of being able to show how we buy and sell in the market. During the COVID lows, which are these over here, one of our strategic moves was to buy the market when it had fallen quite precipitously back then, and of course get out of the market, the little red dots, before it had declined all the way down and lost 33%. And then we participated in the rally all the way up towards the beginning of this year, this little buy signal to now. But then we had been out of the market and we had missed a lot of this bull move in the S&P 500 from around this area where we got out of the market, which was around, looks like around May earlier this year. And then we had remained out of the market all the way up where I turned bearish in the end of August was our last AI, right in this area here. I didn't like the market. So alas, I was right, and the market did go down, and here it is, went down. But then, of course, that was all of September. It did lose 5.5% when I turned bearish. But on the other hand, guess what? October switched it all around, and look, we just ended up October up around 6.5%. The net change from when I turned bearish on the S&P to the end of October was about 1%. So 1 to 1.2% is what it cost me to be remain bearish for those 2 months. But again, I think one of the most fascinating things about mechanized trading, which incorporates algorithms and artificial intelligence both, is the fact that the best mind, and mine is certainly not the best, but there's a lot of great minds out there that feel that the market could go up or go down, and they make their trades based on their best thinking. But math does a better job in the end. During the time that since we spoke last in the end of August area where I was turning bearish, the actual system itself, the main benchmark system, which most of you participate in, actually bought the market on the dip. Notice how it bought it right in here, around 437, 434 area on the S&P Spider is where we got our signal to get into the market. And then, of course, now the people that owned that have bought it around 437 on the S&P are now looking at a price of 464. Folks, you guys, we added 30 points to the S&P from 437. We can do the math. 30 points divided by 437. I'm going to do it. We've just made about 6.8%. And all it did is follow the market. Our risk during that buy, soon after we bought it, is we did lose early on. Intraday, we were down approximately 1.5% from here to here. But then, of course, it has had this enormous rally all the way up to 464. We have 30 points in the S&P. And that is why the math masters the man. Every time. Sorry, let me take that back. Not every time, most of the time. The math is the reason why we're here. You're not here for Kelly Korshak to pontificate his own ideas or his own thoughts or his own concerns. I have the same concerns and worries that most everybody else has about this market falling out of bed. But there's just no denying that math is a better prognosticator of the markets than most men. That being said, you know, our company, as Flip in general, is behind the S&P on the model this year. Regardless, even though we vastly outperformed it in 2020, we have underperformed the S&P this year because of risk management techniques that we use that keep us out of the market. So, for example, most of you will recognize that we haven't been in the market for a long time up until recently when we bought this little dip here, which was literally in, looks like around the 20th of September. We've been out of the market for a lot of the year. But if we were to look at the equity curve of our main model, and this is the main model that we use to help decipher how to trade the overall market. And by the way, a lot of the individual markets, other symbols like everything from ExxonMobil to Apple to Amazon to AT&T, whatever. We use this model to help us make decisions in the underlying stocks inside this index. This graph you guys have seen before. This is the S&P 500 versus the model. The blue line is the S&P 500. The green area, and you could just look at the top of the green area, is the model. So as you can see, the way that we have to run the business to manage money algorithmically is to say that there are going to be times when the market really performs well and we just want to be in it for the ride. And there are going to be times like here, the year 2000 tech bubble, the 2008 financial crisis. This is Brexit over here. This here, of course, is COVID. And what we try to do is mitigate risk during these times. So you can see how our model gets out of the market. We underperform, but then when the market went down here of around 50%, we obviously didn't lose 50% over this period. And the idea of the model is to keep track with the S&P 500, maybe outperform it, but especially manage the risk. That means that people that are older, who might be going into retirement, are are able to be in more aggressive instruments that have higher yields, with the understanding that underneath it, there's some mechanism for managing the risk while you do own these more aggressive products. So that keeps us out of things like bonds that make us no money. So as you can see, when the market is going up, we're trying to be in it, and most of the time we are. And then when the market goes down, what we're trying to do is get out of it. So I kind of remember this one. This was one of our first ones when Flip was formed, right in this area here, 2017, 2018 area. The market was very strong. And then at the end of 2018, we had the Christmas crash because of the Chinese trade bubble. You notice that the market that time lost 20% inside of 2 weeks in the S&P 500 going into Christmas Eve. This is what we lost. This little thing here was about 4.5%. Here, the tech bubble, the COVID bubble did the same kind of thing. The COVID bubble was 33% dip intraday, but we definitely lost more like 9% total. I think it was actually 7.5 to 8.5 from our high to our low, which is right here. We got back long, and since then we've been in the market for the most part up until, as you can see, sometime early this year when we got out of the market, and we've stayed out until we recently got back in. And so we're still outperforming the S&P currently, and we're long the market like everybody else, and that's kind of, folks, a good thing. So I'm going to minimize this screen a little bit here, and I'm going to bring up another screen in a bit. I'm assuming everybody can see my screen. Aaron?
Yeah, we can.
Good. Pardon all my things on the desktop. That's just the way I work. So this is kind of the way the models work, and this is our master model. So I'm going to stop sharing my screen for a second. Meeting controls. So I think the purpose of all of that, folks, was to point out 3 things. One, my bearish call at the end of August, I was only half right. I was right for September, wrong for October. It cost me about 1.5, 1.5%. Regardless, we're not here to listen to me, but I like that people do think of me as offering risk and reward, but that we still behave by the models. It's not me sitting there as the wizard behind some curtain. The wizardry is actually just mathematics that is running in a server somewhere in a cloud. And that bought you guys the market around a 435, 436, 437 area of the spider. And now you guys have about 30 points in it. Excellent. And here's my prognostication for the remainder of the year. We're going higher. Oh, it's so hard to say it. But it's just an undeniable fact that even though the market can have these waves against us that hurt periodically the market for a few weeks, the underlying secular trend is so strong, the strongest in my lifetime. I thought the 90s were strong, but this is not the 90s. This is something different. This is something that I think none of us quite understand. The usual indicators that I looked at most of my life going into September, October, all failed. For example, put call ratios, overall cash, highest level of debt, all of those things that normally the secularness of the cyclical trade that always seems to occur September, October as well. This time it was just September. October turned out to be the exact opposite. This market is so strong that we don't close our eyes to it, but we recognize that we must be in it overall. And that's why the math definitely, like I said, masters the math. I can tell you from my knowledge of the market, though, don't be expecting, if this market goes a little higher, we all might be exiting on the benchmark, the S&P as well. Actually, just another 4% higher will trigger another exit, and we would be taking profits. I suspect that that's going to occur before the end of the year. And when this does occur, and I think it will, we will more than likely again exit the benchmark model, thinking risk and reward are again unbalanced, and there therefore is more risk than reward. So don't be surprised to see us exit the market within the next few weeks as well. But that being said, I'm bullish on the market now. The storm that I thought was going to occur was really, it wasn't a hurricane, it was a tropical storm. And we all survived it, and we actually prospered in it. I hope everybody understands that I'm not flip-flopping here. But at the end of the day, I am a trader, and I have the emotions of everybody else. And that's why at the end, I do like to find the math worked despite my misgivings. So good on that. So there's the market update. I'm bullish for now. The markets are bullish. The benchmark is bullish. Most of our systems are in the market. Total cash percentage-wise of the entire Flip family is now in the area of 75 to 80% invested, which is on the high side. It gets a little higher periodically. And we obviously put on a very, very favorable trade during September. And we're good towards the end of the year. And I think now we'll just carry ourselves and see what Santa has to bring towards Christmas. There's my market update, folks.
Even though you designed this model, sometimes you disagree with it, right?
Often.
And I think that, to me, and I don't know about anybody else on the call here, but for me, that really indicates a level of, like, this is fully automated, right? It's so automated that there's a discrepancy in Kelly's opinion and the automated model, right? The self-driving engine, if you will. So for anyone who thought that, it was just Kelly pulling levers in the back behind the curtain, yeah, I think that alleviates any kind of doubt there. So I'm going to share my screen now, and we'll move on to the next segment, which is the 4Q Rotate update. So this is the 4Q Rotate Smartfolio. We are now invested in these 10 stocks. We used to be invested in like a set of 4 tech stocks. And so if you could illustrate, like, what did the AI see that it decided to invest in these 10 stocks, and like, why now and not before?
Well, first of all, Aaron, maybe go to the top.
Yeah.
And we can go into the individuals and click it back for how are we doing for Q4? It looks like about up 9.5 for Q4 so far.
Let's see.
I see it there in the table.
Oh, right, in the table. Yeah, we're up 9.5%. Yes.
So let's talk about this. It's the 4QR is an extremely aggressive portfolio. It's based on an idea. And let me kind of tell you the idea, which is actually where it came from. Maybe that'll help you. And this is one of the reasons I think Flip is such a good place to be, and why I think too, when we switch into the crypto, which is coming, there's some updates there,
right?
That you'll see that we can apply these things to even more aggressive instruments like cryptocurrencies, and you'll find that these kind of techniques in volatile markets are even more successful. Mm-hmm. So the 4Q Rotate started with a concept called the dogs of the Dow. Maybe some of you out there might have heard of that. There was a concept developed maybe 30 to 40 years ago that if you bought the worst performing 5 stocks of the Dow Jones Industrial 30 on January 1st of every year, whatever the worst 5 stocks were in the previous year, you would buy those 5 stocks and hold them for 1 year. That's called the dogs of the Dow. They were the dog stocks in say 2020, but they were supposedly going to be the good stocks in 2021, for example. Well, the truth of the matter is, now that there was all kinds of mathematical testing on it during the first 20 years of its life, they found that there was no efficacy at all in the dogs of the Dow theory. In other words, it never made money. Never made money. 1 year it might beat the Dow by 5%, and another year it might lose by 5%. In other words, there's no efficacy that this concept worked over time. But if the converse of it was, and the thought of it was that if you bought the worst 5 stocks of the Dow in 1 year, then probably the next year they would cycle to be the better 5 stocks in the subsequent year. And that makes the assumption that all stocks in the Dow are going to go up because the index goes up. I mean, it's relatively interesting in thought, but there was no efficacy mathematically. In other words, if you test it, it doesn't work. But what we did is we said, first of all, the Dow is too tight of an index. Why don't we do it a different way? Why don't we take a look at the best stocks inside of a large group of stocks like the S&P? But we're not going to look at the best stocks in terms of their performance. We're going to look at the best stocks in terms of something called their directional beta. What is that? Directional beta means what is the beta of the stock and what is the direction of the stock? Now, we determine the direction of the stock based on an algorithm, not AI, based on an algorithm. An algorithm says just mathematically what is the direction is just a vector. So you take 2 points, quarter to quarter, 3 months, and you say, okay, did it go up or down during the 3 months? And then we normalize it by adjusting for volatility on the volatility that each stock has. So that we're comparing, if I'm comparing Apple to ExxonMobil, I look at them as both as an apple, not as an apple and an orange, which they are because they're totally different companies. If we do that, and then apply just a little bit of AI that comes from our overall broader model on the S&P 500, what we do is sort through those 500 stocks every quarter, and we pick the ones that are in there. Now, in our case, it's more than the S&P 500 because our universe is a little larger of mappable stocks. And we came up with those 10. And what those 10 said is for the quarter of beginning September, October, November, October, November, December, the fourth quarter in this case, that those 10 stocks, just in an equal weighting, in other words, 10% of your money in each. If you put $1,000 in it, it'll invest $100 into each stock. If you were to do that, you're going to outperform the S&P 500. That's the concept. Now we want to test for that. Well, the testing of that is overwhelmingly positive. The idea came from something that was intuitive but didn't have any value. In other words, no efficacy through a test. But the converse of it and some changing of the ideology of it, don't pick the worst, pick kind of the best, but don't call the best just because they perform good. Look at it in terms of how much volatility they had in having that performance. And this system works, and it does outperform the S&P by and large over huge spans of time. I've tested it back 18 years. We've been running it for about 4 years now, 3 or 4 years now, and we have outperformed.
Right.
And so this concept is something for people that are aggressive. You want to do it. You want to say, you don't know how those stocks are going to, what those stocks are going to be quarter to quarter. So I can tell you on January 1st of next year, 2022, more than likely, none of those stocks will be in your portfolio. They would have been sold out on January 1st and then bought in more than likely January 2nd. In other words, the first day they're out, the last day they're in, the following day they're in, and that's the way that system works. If you think about it conceptually, it kind of makes sense. Things that do well 1 year and they're high performers have a probability that they'll do good the next year, but you probably won't do as well. But it doesn't mean that they won't do well. and we still want to focus on those things. It has a momentum design inside of it, as you can obviously kind of tell, but it also has a volatility risk side built into it to kind of protect you in the event that, hey, maybe something happens during that quarter. What happens if a meteor hits the earth? How do we manage that? Meteor hitting the earth, we're not going to be able to manage, but it would be able to manage it if we kind of knew a little ahead of time. Aside from heading to the place on the earth where we're going to be protected, we might want to get out of our positions prior to that. So we have many such concepts that work just like this. I think that's an exciting and idea. And I think people should be involved in it in some way, especially if they have an aggressive bent to their investment style. But also, I think even if you're not aggressive, then that doesn't mean you can't put a small percentage of your portfolio towards it. So even if you're conservative, you might want to try 10% of your money into something like that, where you have this chance to participate in a concept that I think is exciting, it's interesting, it's new, it's only here, and should really vastly outperform the market over time. By the way, in the first quarter, we've only had 1 month, and the S&P really has only advanced about 1.5% since, since October. We are up 6.5%, but this is up around 9.5 or so.
Right.
And as a result, we're beating the S&P by 3%. Which is good, considering that a 6.5 S&P percent move is incredible. And I think also very interesting to note that take a look at September. You notice we're down. Oh, I can't see.
It says 3.8. We're down 3.8.
And the S&P was down 5.5 in September. So the idea is, again, we've outperformed when it goes up, and we've also outperformed when it goes down. That's kind of the idea of what we're looking for. So that's a new thing, not new, but it did have a big change in rotation this last quarter, and expected again in the following quarter.
Right. One of the things that I know that people may be thinking about is, does this mean that the stocks will swap every quarter? I think the previous set of 4 stocks with the Spider, the Microsoft, and Apple, and we held it for a couple of quarters. Actually,
yes.
Right?
And what happens there is the AI component is putting a risk on. The AI component at Flip is a risk on, risk off indicator, and it's actually a set, and it has subdivisions of it. So is it risk on? Well, is that 100% risk on, which means you're 100% long the market, for example? But it could be risk on 50%. Well, at certain risk on levels, if the risk on is not strong, which is why we were out of the S&P a lot of this year earlier in the year, is the reason why it's stuck with some very consistent companies. Like Microsoft was one of those components for all those months. Microsoft did very well. Why? Because you have to have some risk on. It was at that time around 50% risk on, and sometimes as low as 40% risk on. So if it's trying to say there's a lot of risk in the market, you have to stay with very strong, knowable stocks, and that's what it did. It defaulted to the old, strong, known stocks to protect itself. It was basically hiding from the market for those quarters. Now it did well, but at the same time, that was because risk off came off towards the end of the third quarter, somewhere around August. And of course, we can't rotate once it comes off. We just have to wait till the following quarter. And that's why there was this big change on October 1st.
So I think the thing to note there, everyone, and this is a little bit on the product side as well. You can expect to see a swap. If you're invested in the 4Q rotate, you can expect to see a swap usually every quarter, but sometimes that might not happen. Also to notice, and this is more up from the product update side, that when stocks swap out, your minimum investment is likely to change because different number of stocks with different price per share. Now, just this is relevant to one of the segments we have upcoming next with the product update is we do have fractional shares coming in soon. It's pretty imminent. And when that happens, the minimum investment, especially for something like this, will no longer be as much of a big factor, right? Because you're able to buy fractions of shares of each. So we may still put some kind of minimum just for just to keep it reasonable, but it won't be as much of a change because I think this particular smartfolio went from a minimum investment of like a thousand or like $800 all the way to 8,000 because there's so many more stocks now. So it won't be as big of a swing. I know that was a little bit of a challenge for some of our customers out there. So did you have something to add, Kelly?
Yeah, I was just going to add is that moving to fractions has more meaning, especially to iFlip users than it does to, for example, a Charles Schwab user or a Robinhood user, mostly because we're building combined product. As a software company, we put together sets of stocks that are in an aggregate, and we're trading them mathematically. And when you do that, if you have say $1,000 to invest, oftentimes, and when I buy 10 stocks or even 5 stocks, that means when I divide, if I'm investing equally, and we normally do that, that means that, of course, that if I have a stock for $40, I may not be able to get the whole amount, and I only can put $200 towards it. I may be off. I can't buy more because people say, I only want to put 1,000 in. That means, and I had 10 stocks, that means it's 100. But if the stock is a $60 stock, I'll just do it that way. It means I can only buy 1 share. And then the other $40 has to sit in cash. That may help you or hurt you, but at the end of the day, it's not as efficient as it could be under fractions. Fractions will make all of our portfolios far more accurate.
Right.
And they will, that doesn't mean they'll do better. It just means that they'll have all the money invested.
Right.
Or not, but it means that they'll be invested exactly in the right proportions.
Right. We'll have increased precision in the way we deploy your capital.
Well, increased precision.
Right. And there is one question that I am going to address right now because it is so relevant to the topic that we're talking about at the moment, from Ryan Everett. Appreciate the question, Ryan. What happens in the instance where the minimum goes from 1,000 to 8,000, but you only have, say, 2,000 invested in Smartfolio? This is a great question. It's more of a product question. You're able to add as much money as you can. So let's say you're able to, you want to add another $2,000, but that would still put you under the minimum of 8,000, right? Because 2 + 2 is 4, you're still under 8, but you're able to do that, right? In any other circumstance, if you were to try to deposit $4,000 into an $8,000 requirement, it wouldn't let you. But in that particular case where the minimum has been increased on you, it will allow incremental deposits. However, it won't allow incremental withdrawals. Your only option for a withdrawal is to do a full withdrawal. You can't take like $500 out or anything like that. That won't allow you to do that. Okay, got it. Okay, great. Thanks, Ryan, for the question. And so I'm going to move on to the remainder of the product update. That's a good segue because fractional shares is one of the things it's coming soon. So just very quick update on the crypto side of things, which I know that if some of you may have already been on the pre-release, super excited about it. And this is the update. So much has changed since we've decided that crypto is going to be part of our arsenal, the iFlip arsenal. One of the things that we did decide, we could decide to either use it as a currency where you can utilize Bitcoin as like actual money. You could send your Bitcoin to your friends and family and stuff like that, if you, the way that you can with, let's say, Coinbase, for example. Or we can treat it like an asset, which is more of what you would experience with a Robinhood or a Webull, where you buy and hold it and you treat it like it's an investment, right? Kind of like you would buy a digital gold kind of thing, right? You buy and hold. There's no utility to it. You can't use it to buy something, but you're invested in it. So we know now that we are going to go with cryptocurrency as an asset. And so we're firm on that. What that means for you for our customers is that very little will change. Your user experience, the UI, and everything will pretty much all stay the same. But as you can see in our web app over here, one of the key distinctions between manually traded stocks versus Smartfolio traded stocks and also custom traded stocks is the look and feel of it. So if I go into my custom Smartfolio, my cannabis custom Smartfolio in this account over here, the background changes. It's more of a pattern, textured background. There's a different look and feel. So we're going to keep that theme consistent. And so the only thing that'll change for you is that you will have a different look and feel for crypto. You'll be able to search crypto up here with alongside your stocks. If I were to start searching for AA, it'll autocomplete with like Apple and all that kind of stuff. It'll also autocomplete with crypto. So you'll be searching stocks and crypto side by side, which is very convenient. So because we know we're keeping this as an asset, we know how the user interface and experience will be as well. If it's just going to be similar to the other apps out there, like, what's the point? Why would I wait? Why don't I just go out and buy Bitcoin on Robinhood or Webull or some of the other guys that already offer it now? Well, the same reason you buy your stocks with us as well is because we have the iFlip AI that nobody else has. We're able to, and I hope you don't mind me doing a little tiny spoiler alert here, Kelly, but we did get to see our back testing model of how we would have done with Bitcoin and its crazy moves, right? Remember, it was at 61s and then it went to 30 and then then it hit 60 again, and all in a matter of months, right? That kind of volatility is pretty crazy, right? And our AI, to say the least, and Kelly, you can chime in on this a little bit if you want, but our AI is handling that quite well, right? And I don't have anything to show, but yeah, go ahead.
Now, everybody, pardon me. I have the late night workers in the background doing some repair on the piping in the kitchen. But I actually have something to show, and I want to show it. Can we share the screen again?
Oh yeah, sure, absolutely. We can. Well, before you show that, the last thing I wanted to add is that we do have the masterclass coming as well. Obviously, crypto is like I just said, it's a crazy volatile, new kind of mysterious, esoteric kind of asset class that warrants a lot of education around it in order for you to feel comfortable. Obviously, we want everyone here to understand where their capital is being deployed to. So we do have a masterclass coming, led by none other than Kelly Korshak and also our Chief Growth Officer, Rob Simone, right? So it'll be like a 1-2 punch there. Super excited for that. That's coming soon as well. Kelly, yeah, it's all yours. I'll stop my share. You can go ahead.
This is Bitcoin.
Oh, okay.
This is the actual coin. I have this just from about a week ago, 10/26. So going back to what Aaron said, it's either an asset or a currency. We look at it as an asset. People that are on our platform, I think, are interested in using it in two ways. One of them is a store of wealth. Well, a store of wealth, you can buy it on Coinbase, buy it on Binance, buy it at Robinhood, and you own it. And if you want to trade it, you can go in and out and buy it and sell it. With us, you can do the same things, but we look at it as it'll be incorporated into a lot of different portfolios. Some of those portfolios will be strictly crypto. And therefore, if it's in a portfolio, it is definitely an asset. It is not going to be looked at as a currency that's fungible, where you're going to trade it for, staying at the Hyatt or going to a restaurant.
Mhm.
So there's two components of crypto and the mathematics behind it. One of them is you can buy and hold it. And we all know what buy and hold of crypto looks like. And it looks a lot like this. So forget the little red dots and blue dots for now, everybody. But if you just look at it, this is kind of a map of crypto all the way back to 2016, where kind of the origination area of where it started. In before that, of course, it started even cheaper. But you'll see here that we're looking at prices at around $370 per coin all the way back then. And we know it was cheaper than that prior to it. So when you look at a chart that's not logarithmic, don't be surprised. But inside of this thing that looks like it's a very consistent price, it's moving around 10, 20, 100, 30, 70%.
Right.
So it looks steady, but it's not. If I were to zoom in on that area, you would find that it's actually extremely volatile. And a matter of fact, if I were to zoom in on that area, it would look a lot like this area over here on the right, which is recent. So that's something to note. This is still an extremely volatile market. And there's two thoughts on it. One thought is that we buy and hold it because we believe there's a lot of people out there that believe it is going to go much higher. It is going to be an international currency, a currency that is amorphous. In other words, there's no head, there's no sovereign, China, America, Europe, that will control this. This is controlled by the people. It is the ultimate democratization of something that can be bartered and traded and used as cash at some time in the future. But for now, let's just look at it as an asset. An asset like a dollar or a euro or an RMB in China or a real in Brazil is something that we use to go buy goods and services like bread or milk or beer. And we need those things to be consistent so that we understand how much we can pay for bread, milk, and beer. But this is something that we're really not thinking of buying those kind of commodities with. We're thinking of owning this because we believe it has a higher value in the future. And also, it's exciting, and we know that it moves around. And we also know that generally it moves up. So therefore, we want to own it. But owning something this volatile does require two components, and this will be taught in the master class. One of them is you should own some, and you just put it away, and you own it as an asset, and you hold it just like you would hold gold or a Krugerrand or silver that many of you might have either in a safety deposit box or somewhere underneath your mattress. But this is something that is highly tradable. And if it's tradable with this kind of volatility, that means it can be both arbitraged. In other words, it can be traded against something else to make a profit. And second of all, it is also tradable algorithmically using AI. The blue and red dots represent, as you've seen before on my screens, the idea of buying it and selling it. So the case here of crypto is this is just one concept, a momentum-based concept of trading a cryptocurrency, Bitcoin, in this case, Bitcoin, but it works the same on Ethereum, Litecoin, and others. But we have a lot of data on Bitcoin, so it's a great place to start. If you notice, it looks like a bunch of red dots and blue dots. The red dots mean you buy it, and then you sell it. You buy it, then you sell it. Notice there's a lot of trades. Notice, you buy it here, you sold it up here. You bought it here, and you sold it there. You lost a little. You bought it here, you sold it there. You made a little. Same thing, it buys and sells, and it does it consistently. Literally, it looks to me like it does it, and I can tell you that it does it generally about once a week. Once a week, this will be in the market. But you might notice something. If you do, you'll notice that we sold it here, for example, and we didn't try buying it for a long time. Matter of fact, the first time we tried to buy it, we lost, and we lost that. And then we bought it, we lost again. And guess what? We bought it and lost again. And then finally we bought it and we made some money. So we have these trades that we're trying to buy it, but we have to sell it because it doesn't follow through. That's why it's a momentum model. Let's take a look at something though. Here's what's exciting. If you look, the Bitcoin again is the blue. This chart should look, remember recently, back in earlier this year, 2021, we had the 50% drop.
Right.
This went down to like 29,000 down here. This was about 60,000 up here. Then we took it all the way back up. The green is the algorithm and math trading it. Notice when Bitcoin is not doing anything, like it is we're here in 2019, 2018, we're not doing it and we're not making any money. But we're not losing either. Take a look. People that are trying to buy this market here they might make money if they're smart enough to get in and out of some of these little things. But overall, if you're just a buy and hold strategy, and I remember this time in the beginning of 2018, nobody made money in crypto literally through until really right around here until the March of 2019. So that's like 15 months. Crypto actually just kind of went down before it started to live again. Notice that notice what the model did. The model just kind of stayed steady. It stayed out of the market. It tried a few trades, but it didn't go anywhere. It didn't lose, didn't make. It was trying, it was probing the market. Market starts to rally here. We start to put on trades and we participate. But notice how we participate. We participate in leaps, then we flatten. We leap, flatten, leap a little tiny bit, and then we flatten. But look at the market, it didn't do anything. Now when the market starts to finally put on the Ritz, look, we leap too. We leap too. And then look what happened here. Market started getting very volatile. We're out. See, we stay here. The market went down all the way down here. We didn't buy it here. There's other models that bought it here. And we did lose. This market lost 50%. We lost 20% from there, that little high to there. Guess what now? The thing exploded higher again and we made new highs along with it. But we didn't take this risk. So to me, folks, and I think to all of you, I think you can conceptually see what we're going to do in that masterclass is we're going to deploy models like this and others that are completely different than this model. We're going to trade them together. And we're also going to just own it outright. And if you do these things in aggregate, these things create a much smoother ride in the ownership of your cryptocurrencies than if you just try to just simply buy it. We want to be long, but at the same time, there are times not to be. This is not a market that can instill trust to just be long. Right. Everybody knows that most of the time, and we've seen this many times, this can lose 50%. And gosh knows, many people, especially of my generation, think it could lose everything. I'm not one of those, but if that was the case, that will not happen to those that are using this kind of methodology. This is the stuff, folks. This is where Flip wants to be participating in. This is a opportunity to participate in probably one of the newest, more possibilities that is going to change the way this world functions over the next 10 years. Think of this similar to like a Tesla, something that's changing the infrastructure of society in the way we might buy and sell goods. Same as electric cars are changing the way we look at transportation. We will go into the masterclass on these models, and I just wanted to give everybody a quick show of what I've been working on in the background. And there's maybe 3 more models just like this. So this will become part of a big portfolio that we will put together in the future under our crypto, when our crypto comes to the platform. So I just wanted to throw it out there. To me, that's really kind of cool cool stuff.
Yeah, no, I'm glad you did. I know we were a little bit over time, but I'm glad you showed that. I wasn't actually planning for that, even though I have seen that before. And what I was going to say before was it looks like it's doing the thing that everybody says you should be doing, is buy low and sell high, but it's doing it without causing you, the viewer, the customer, any stress because it's automated. How stressful is it to, especially if you're a beginner trader and you're just getting started in this, to try and trade something that can move 50% on like a whim? It's very, very stressful. I know because I've tried. It is very stressful. So if anything, iFlip is giving you peace of mind in that sense. And I think JJ said it best here, considering the volatility of crypto, iFlip is the only way I want to be in the crypto market. And yes, we will get it. We will take some questions now. I just didn't want to interrupt Kelly because that was actually a bonus update that you got that I wasn't actually planning for, but y'all got a bonus there. So let's go back. I'm going to group up some of these questions because we do have some repeats. Kelly, a bunch of people are asking with the world the way that it is, considering with the issues with energy, how do you expect the energy related stocks in both red oil and there's some in SPY? How do you feel about that? What's your forecast?
Well, by the way, speaking of stress, everybody, the stress I have right now is that thing in the background. It is like whining in my ear at 5 o'clock at night Pacific time. It's like, I mean, you got to be kidding me. I mean, sorry. So I really pardon that, but if I didn't try getting workers these days to get something done in a work shortage in
Right.
the field of updating certain aspects of your house. So I'm really sorry about that, folks. I'm very bullish on SPY and red oil, and I'm especially bullish on both for this particular reason. Both of them contain some pipeline stocks. Pipeline stocks, the reality is that we have an energy crisis now that is made by our own government. I think it's pretty well obvious at this point. Our government created this, especially in this country that is oil rich. We are a net exporter if we want to be. But no, our government decided to move in a different direction that is not just expensive, but frankly, foolish. I understand global warming. I understand those processes, but I also understand that people need to drive places and it costs now literally about 70% more to drive places. And most of that's due to shutting down specifically pipelines. Energy Transfer, All Plains American, both of those things are in the red oil and one of them is in the SPY. And I think at least one of them is in the SPY. Those components are things that are going to have to be reactivated either by Congress or the president. Well, the president won't do it, but Congress may be able to do it a year from now. And if they do, yes, they will solve some of the oil shortages. It would be nice to see some oil coming down from Alaska and being able to, in going up from the Gulf to get to the midsection of this country, the West, here in Arizona, many other places. So those stocks have a long way to go. And they are just depressed because the government has literally shut them down. That being said, these are stocks that I would just want anybody to own. If I were to give someone a tip, and we're not advisors, but the tips are to say, hey, these are the things that are sleepers and they're going to double in price. So that's number one. Oil is bullish. I don't see how we can not look at it. We have an inflationary environment, and if it's going to be inflation, commodities prices rise. What's the most well-known commodity? Oil, energy. So that takes care of red oil, bullish. SPY, what's in that portfolio from US Steel to the spider growth stocks to an oil stock to a cruise line. Again, I feel those are still have a chance to maybe go up another 30 to 75% over the next year or less, much less is my guess. And why? Most of the world, at least in this country, knows that COVID is really in the rearview mirror. I mean, other people around the world, and there are those still in this country that emphasize it. I don't understand that. I guess I'm conceptually out of touch with it, but I'm not out of touch with how you should invest in these kind of things.
Mm.
So at the end of the day, I think the masks are in the rear view mirror. I think COVID is over, and eventually people will realize it, and they will get on that cruise ship and not be afraid that if they catch it, that that's some kind of a death sentence. There are those people in the media that make it feel that way, but it's simply not true. The data doesn't suggest that at all. And the stocks that are in these portfolios are, I feel, artificially oppressed. And at some point, that's going to change either by government or just the realization that the COVID environment that still seems to exist is largely out of fear. And as FDR said, I mean, it's fear itself is what we must be afraid of. This innate kind of fear that just simply shouldn't be there. So yeah, folks, I like those two portfolios. I like a lot. Those are the go-to portfolios in my mind. And the 4QR for those more aggressive. And frankly, like I started off this webinar with Aaron, I'm bullish until the end of the year. At least the end of the year. Next year, towards Christmas, we're going to do another one of these, probably maybe two more before Christmas, one more before Christmas, and then do one right around then. Now, at the end of the year, I want to make another assessment, and you will hear my opinion for what it'll be worth at that time. And we'll see what I have to say then, and you can take it or leave it if it's any good. But either way, math is the model that makes the most sense.
Got it. Let's squeeze in a couple of more, and we'll keep it very, very brief because we are already over time.
I know, but
but it's okay. I mean, it was great stuff. I wouldn't have had it any other way. There are a couple of questions regarding, speaking of government politics and policies and stuff like that. Is there two kind of related questions? Is the strong surge in the market due to the dollar losing value, or due to actual improvements or in the marketplace, or manipulation, or something else? And also, what are your thoughts about assets potentially selling off because of Biden's prospective tax plan, all in the realm of political influence and manipulation on the markets?
Well, I'll try to answer that the best I can. The markets certainly know what Joe Biden is doing, and they're rallying in front of it. What I'm seeing is classic gridlock now in Washington. Gridlock means the markets go higher. Why? They already know what the taxes are. They already know what money is in the system. What makes people nervous, especially investors, is what they don't know. What can Congress do to change all of this? The main thing they can do is pull money out of the system. If they pull money out of the system, in other words, they increase interest rates, they do something called overnight repos, change the reserve requirement to be higher. Those are the ways the Federal Reserve can control monetary policy. In the form of fiscal policy, which comes from Congress, the way they do it is they either create programs like they're trying to create the $3.5 trillion that's now down to $1.75 trillion, not including the infrastructure bill, which is $1.5 trillion. If the infrastructure bill or the other bill that doesn't look likely anymore pass, that's going to add more cash to the system, and stocks are going to go higher. So it has nothing right now to do with the dollar or interest rates. Today, Jerome Powell said the interest rates are going to remain steady through much of 2022. I think he's frankly wrong, but whatever I think is meaningless. I think that's what they're going to do, because they still perceive COVID as more of a threat than inflation, which boggles my mind. I'm sure many out there would agree with that. But regardless, these are things that keep the market bid. And if it continues to be bid, you can't sell it out yet. So this is one of those occasions where the country seems to be moving one way. The markets are definitely moving up. And this kind of, and what happened last night with Republican victory in Virginia actually supports even further. Market's going higher, regardless of Joe Biden, Congress, or the value of the dollar against the euro or other currencies. As means no difference, going up.
Gotcha. And this is coming from Dylan Newcomb. Are you guys developing any crypto smartfolios that also profit from coins dips, basically shorting? Or...
No,
Okay.
no, for now is the simple answer. I can be more expatiate much further on that. Part of
We'll save that. Let's save that for the masterclass, not give away.
Because the masterclass will explain why.
Right.
That, and in general, though, I will say one thing: you don't short a market that generally wants to only go higher or is designed to go higher. Bitcoin, for example, is a market that's designed to go higher. It's hard to short. In other words, there's a fixed supply. It's hard to short things like that. You might be right, but you're only going to be right for such a short period of time that it's better to just sit on the sideline and get long at a later date. But we'll go more into that.
For sure, for sure. And Art asked, how do we sign up for the masterclass? In case anybody else here is wondering the same, just email sales@iflipinvest.com. I don't have any control over that. I can't do anything about that here on this webinar. Just email sales@iflipinvest.com. There's a couple of other product questions that I can handle. Are you working on a set and forget product for those of us who don't do a good job of allocating our funds between the different smartfolios? We've actually had this come up a lot because now that we offer so many different styles of our smartfolio, that it's almost putting putting the burden on the customer to be able to choose correctly. And so with customization might come a little bit of analysis by paralysis. So we are working on a not just the smartfolio, but smart allocation type of concept. And that is something that we are working on for people like for Art and people who like that. Thank you. You got it, man. So we answered that. And there was another question. Short-term trades. So does the algorithm ever buy and sell like mid-trading day? And the answer is at least for now, our Smartfolio AI does the math and it buys on the open. And it executes on the open. It knows at like right around 9:30 Eastern whether or not it wants to buy a stock that you have in your custom smartfolio or one of your preset smartfolios. It buys on the open.
Right.
Yeah. And there was another question. This is the last one, but I think this is a little bit more of a niche, like user specific question because Andrew, you had a question about your custom smartfolio, basically buying high and selling low. I understand that can be a little frustrating, but it is a custom smartfolio. And so that requires a more of a deeper conversation that we just don't have the time for on this particular call. So I would suggest email support.
Email you and I might be able to help answer that one. I mean, that's an example of the thing I showed everybody just recently in the crypto trading method, where a lot of times it feels like you're buying high and then you're getting out with these losses. So, but it's sort of like anteing in a game of poker. You got to ante, you fold, you ante, you fold. You're losing, you're getting chipped away. But when you decide to play, it's because your hand is stronger. So the answer to it lies inside of that concept because there are mathematical betting models that I also use that are deployed underneath this. So that actually is a good question, but it's generally answered the way I did. But now everybody, I got to at least sign off for now. I hope hopefully people could glean some information out here. Kind of exciting times. I think people are doing very well in their portfolios. I'm very pleased with that. And there is new things to come. And let's charge into the end of the year, folks.
Yes, absolutely. And that'll do for this extra long session of the AI Circle. Thank you so much for everybody. If you want support on your custom smart folios, Andrew, just email support@iflipinvest.com
Yes, I saw that.
for anything regarding your custom smartfolio, and we will get you that live concierge support, especially if you are a pro or advanced customer. If you have questions about the masterclass, that would be at sales@iflipinvest.com for all questions regarding the masterclass. With that, thank you for everybody, and
Bye.
good night.
Thanks, Aaron. Take care, man.
Thank you, Kelly. Take care. Bye now.
See you, JJ.